Hello, everyone, and welcome to your 2026 market update. The first half of 2026 has been anything but quiet. Between changing trade policies, ongoing geopolitical tensions, and continued excitement around artificial intelligence, investors have had plenty of headlines to process. Yet despite all of that uncertainty, markets have remained remarkably resilient. One theme that is agreed on is that artificial intelligence continues to be one of the biggest drivers of the market. AI-related spending is accelerating, corporate earnings are remaining strong, and tech companies have been leading much of the market gains. Analysts expect that strength to continue through the second half of the year, supported by resilient economic growth and continued investment into AI. However, we also urge investors not to confuse a great company with a great investment. At Prosperitas, we encourage innovation, but we're also cautious about paying too much for future expectations. Today's AI companies and leaders are priced for significant success, leaving less room for disappointment if growth slows. But our philosophy remains focused on buying high-quality businesses only when their valuations provide a meaningful margin of safety. That same philosophy explains our views on today's wave of IPOs. While exciting companies like SpaceX have generated tremendous interest, history reminds us that IPOs are often designed to benefit the sellers first. Great businesses don't always make great investments if the price is too high. Instead, we continue looking for opportunities where strong businesses have temporarily fallen out of favor and can be purchased at attractive valuations. Experts also point out another important trend: market concentration. Today, a relatively small number of large tech companies represent an increasingly larger share of market returns. While their earnings have justified much of that performance, history suggests that market leadership eventually broadens. And that reinforces the importance of diversification across sectors, across regions, across asset classes, rather than just relying on a handful of stocks. Looking ahead, we remain constructive on global equities, particularly in the US and in emerging markets, while also seeing opportunities in high-quality fixed income, infrastructure, and alternative investments as investors navigate an environment of persistent inflation and geopolitical uncertainty. Our outlook remains balanced. We believe there are genuine reasons to be optimistic about the long-term economy and the opportunities ahead. But we also recognize that disciplined investing requires patience. It requires thoughtful risk management and avoiding the temptation to chase whatever is most popular today. As always, thank you for your continued trust. I appreciate the opportunity to help you stay focused on long-term goals, regardless of what the headlines may be bringing. Thank you so much.